Can you like mute your mic, please? All right, thank you. We're trying to charge this. Okay, so yeah, we talked about the rally based drop, right, which is supposed to be a supply zone. Price goes up. Like I said, you don't really need to worry about this rally to the upside. It's usually the downside that you need to worry about. So if this is really moving really slow, then it's not really considered as a supply zone. It has to be really strong. So the strong, if this is really strong, then meaning if price gets to that zone, price is more likely to move to the downside. But if this is not really strong, then meaning this zone is weak. So sometimes you see rejections, but price doesn't really, you know, stay long at this region. Price goes down, see some indication, and goes back up. Especially when there is, a lot of news coming out. All right, so this is a drop base drop, right? A drop base drop. So drop base drop is sort of like, if I was trading with price action, right? I'll call this drop base drop like a continuation pattern, meaning price is going down. You see some correction, and then what we usually do is we draw what this around this zone, and then price goes down. So this base is gonna be what our supply base for drop base drop. So drop base drop. So with a drop base drop, this is how it looks like, right? Price drops, you see a base, a brief, it has to be a brief consolidation, right? It doesn't have to be this. This is not, so this wouldn't be a supply zone. It has to be brief. A drop, and then you have a brief, and then it keeps going back down. So we usually expect price to go back, hit this, and then go back down, right? This is also an example. A drop base. Remember, I told you it doesn't have to be more than 6 candlesticks. So 1, 2, 3, and then right after this, you see a very strong move to the downside. So a drop base and then drop. This is also an example. A drop, base, and drop. But this is not the zone, right? The zone was supposed to be at this side. That was why price broke this. But this is also called a supply zone. It depends. So this person was actually not trading with the exact demand and supply, even though he had this, right? Because usually when you are trading with demand and supply, it's usually limit orders. So if you have your limit orders and then you have your stop loss at this region, then this is literally gonna hit your stop loss. This is a rally base rally, meaning price is going up. You see a brief consolidation, then price what continues to the upside. So price goes up, a base, right? And then price goes back up. You expect price to go back to the same region, which is this side, and price will go what? Back up. As you can see, a rally, a base, and then a rally. Price returned back to the zone and price went back up. Same thing, right? A rally, base, rally. This is the base, and then price goes back up. A rally, base, rally. Same thing. Okay, so introduction to drawing supply and demand zones. So how do you draw a supply and demand zone? We have something called the distal line, which is this, and then the Prisma line, which is um the base is gonna be. So the first line is gonna be on top. The second line is gonna be at the bottom, right? Just like this, as you can see on this one. Now, this is how you draw the lines. Your first candlestick, right, is gonna be at the basing candlestick before the momentum rally. So let me use a pencil. So imagine price, you have a brief consolidation at this side and price goes down like this, right? Your base, your first candlestick is your first line is gonna be the the bearish candlestick. So if price, okay, let's do this. If price goes down like this, then it's gonna be the bullish candlestick, meaning the candlestick that looks like it's going up, which is going to be the blue one, right? Before the momentum rally. I don't know if you actually understand what I'm saying. So this was the rally to the downside. So your candlestick is gonna be at this side, and then your the last line is gonna be on top of the last wick. So this is your last wick, right? And also the second thing is you can also have, so usually this is how it looks like. Let me use trading view and then we'll get back to this. So if I was drawing a demand structure, let me pick, okay, let's say I'm drawing a demand structure at this side, right? This was the last bullish candlestick before the rally. We have a lot of bullish candlesticks here. This is bullish, this is bullish, this is bullish. This is the last bullish candlestick before the rally. So my first line is going to be at this side. And then my second line is going to be at this side, right? So you expect price to get back to this region and then drop. Okay. You can also have this side as well, your demand structure. So we have different types, right? The first one is going to be this, which I told you, the last bullish candlestick before the rally. This is the rally to the downside. And this is the last bullish candlestick. This is also a bullish candlestick. This is also a bullish candlestick. But this one is the last one, right? So your base is going to be at this last and then before the momentum was rally. And then your last one is going to be at the last wick. This is a wick. If I was looking at this, then this is going to be the wick. If I was looking at this, then this is going to be what? The wick. Now, the second one is if you have a very quick rally, like if you have something like this, let me use, right? So if you have something like this, price went up and then you have a very quick move to the downside. Now, with this type of supply structure, your demand, your lines, right, is going to be, which looks like this, right? A quick up to the upside and then a quick move to the downside. It's going to start from the wick. See this wick? Your first line is going to be, which is the distal line, is going to be at this line. And then your last line is going to be on top of the last wick. So it's going to be from wick to wick, from this low wick to this high wick. And then you expect price to tap onto that level and go back down, right? And then the next strategy is if you have a very strong move like this, so let's imagine price goes up like this. Once price get to this place, you see a very small candlestick at this side, right? And then price goes back down. Now, for this type of structure, your candlestick or your line is going to be on the body. An example is this, on the body of the what? The candle. And then your line is always going to be at the last wick. So this is how it's going to look like, right? An example is this. You can either put your line at this side or on the body. And then the last wick is always going to be your what? So this is how the structure looks like, right? So your distal line, we have the Prisma line and then the distal line. The Prisma line is always going to be the one that you always use as your limit order. This one. And then the distal line is going to be your stop loss. So as you can see, basically what he did around, what this guy did around this side was that he used his what Prisma line at the last basing candlestick before the momentum rally, right? So the last candlestick that happened before that rally. So this is how like order block actually works. If you, I know you know what order block is. So it kind of like have some similarities with order block. So this was the last candlestick before this rally, right? So you put it here and then you put it here before this rally. But sometimes, right? So this, see, a rally to the downside, sorry, a drop to the downside, you have a base and then you have what? A drop. So it's gonna be like this. This is how your structure is gonna. You can either put your line at this side or at this side, right? And then we'll be talking about this type of structure. See, this side got broken, right? But we'll be talking about this when we get to risk management, and then the freshness of the zone, and then the monthly time frame alignment. With a monthly time frame alignment, the freshness of the zone, it shows you exactly where the good demand and supply zones are. So these are types of demand and supply. These all what I'm showing you, right? These things are all types of demand and supply trading. But you actually want to get a zone which is more likely to move, high to the upside. So what I'm basically saying is, let's imagine price went down to this side, right? I told you this is what a supply structure. This is a supply structure. This is a supply structure. But you want to find a zone where if market should, approach that level, the market is more likely to move all the way to the downside, because market can approach this level and you might see a rejection to the downside, but market will not go all the way to the downside. Market will just retrace like this and go back and breaks your level, right? But sometimes you have a zone where market reaches that zone, like this zone, and then goes all the way to the downside, right? So when we get to the freshness of the zone, the momentum rally of the move, you actually understand what I'm saying, right? So this is how to draw a demand. This is how to draw a supply zone. And then for the demand zone, it's always going to be the basing candlestick before what? The momentum rally. So this was the candlestick before the rally to the upside. The basing candle, this was the candlestick before the rally to the upside, right? So the last candlestick before the rally to the upside, which is this one before this went up. So your line is going to be your distal line, your proximal line is going to be at this side, your distal line is going to be at this side. All right, so I'll take a screenshot of this and send it to you. This talks about um so with a demand and supply, right? Sometimes it depends. You have different types of what candlestick. This is a bullish pin bar as a basing what candle. So if you have a pin bar like this as a basing candlestick, then it's the same thing. This was a candlestick before the momentum was rally. Your proximal line is going to be on the wick or on the body, right? If you have it on the body, this will what hit your order and go back into your profit. So you can either put your distal line on top of the wick, right, the high, or on the body. But your distal line is always going to be on the last wick, as you can see. Same thing, right? You can put your proximal line on the body or on the what, on the high of the wick, and then your distal line is always going to be on the last wick. And price goes up, right? This was a very huge momentum rally to the upside. So price goes up like this, and then price return back to the zone. Once price return back to the zone, right, price goes back up. So this is also an example for a supply zone, right? This was a very strong move to the downside. This was what, a pin bar candlestick, and then your proximal line is always going to be what, on the body or on the wick, and then your distal line is going to be on the last wick. Same thing, right? This was the rally to the downside, the momentum. So remember, I was talking about it has to be a very strong candlestick to the downside. Once you have this strong candlestick to the downside, then you look for the the candlestick before the rally. So this was the candlestick before the drop. The proximal line is going to be on the low, right? For a supply zone, it's going to be on the low, and then your distal line is going to be on the last wick. I'll show you like examples on real life charts so you can actually see how it works. Right, for an engulfing candlestick. So basically, it's the same thing, right? On The proximal line is always going to be on the body or on the wick, and then your distal line is going to be what? On the last wick. It's basically the same thing. All right, so let's talk about this. How to find quality supply and demand zone, right? So this is where you actually find accurate demand zones. So it talks about the strength of the move, the strength of the move. Let's look at something. For a demand zone, the strength of the move, it says strong move, right? Strong move, weak move. So if price is going up, usually you want to see something like this. This is the base. You want to see price going up like this. If price is struggling to go up, then the move is really weak. The move is not strong. So this zone wouldn't be what? A demand zone. If price is going down, you want to see something like this. You don't want to see price doing this. If you have price doing this, then this is not going to be what? A demand zone. This is going to be a very weak zone like this, right? These are weak zones. These are strong zones, but these are not strong as compared to this one. So once you see zones like this, then this is more likely to move to the downside compared to this one. An example is this, right? You have a base right here. Price move all the way to the downside. Look at the base, look at the candlestick, right? A quick move to the downside. It was really quick, right? Up, quick, boom to the downside. Now this becomes what? A supply zone. You expect price to get back to this region and go back down. This is also going to be what? Another supply zone. And this is where we talk about the freshness of the zone. We haven't got into this freshness of the zone, but this is what we talk about the freshness of the zone. So imagine this has already happened, and I was trying to find for demand zone. This wouldn't be my demand zone because this move is not what? It's not fresh, but this is what is fresh. So freshness means that this zone hasn't been mitigated. So mitigation is if you have a zone, right? Let's say this is my demand zone. I'm expecting price to go back down. Price goes back into the zone. Price moves down. Now this zone is not valid anymore because price has already what got into this region. So this is what I talk. This is what I mean when I talk about the freshness of the zone. The price. This zone has to be fresh, meaning this shouldn't be at this level. Once this gets to this level and goes back down, then this is not valid or classified as a demand zone. Your next demand zone is going to be at this side. But as you can see, a quick move to the downside. So the rally is not this is a rally based drop. If you move to a lower time frame, I told you the rally is not. You don't really look at this side. You only consider the strong the strength of the move when the move is moving down, right? So if this move really quick to the downside, then this zone I'll be classifying this zone as what as my demand zone. I'll be expecting price to return back to this region. Price goes down. Price move up like this. This is your zone. Price should move all the way down to the downside. Now, if price is moving like this, like I told you, right? If price is moving like this, then this zone is not really strong. This is not strong. Price should move down like this. Now, once price moves down like this, then I classify this what as a demand, sorry, as a supply zone or supply structure. But if price was struggling, let's say if this side was my demand zone, look at how price was moving and then a rally. This is not really strong. So if price get to this side, then this side is more likely to what? Get broken. All right. See, same thing. The strength of the move, right? A really strong move to the downside. It was quick. See, this is a secret. It has to be quick and strong. Quick and strong. Rally base, then goes back down. Right? Rally base, quick move to the downside. It has to be quick. Anytime you have a this is not a move because this is a consolidation zone, right? And if you can see something, it says a powerful demand zone. It's usually places where you see gap, right? Gaps. Meaning this was so strong that market you weren't even able to see the candles. This just jumped all the way to the upside. If you understand what I mean, right? The move was so strong that market didn't what create candlesticks around the side. It jumped. So this is a very powerful zone. So if price should retrace back to that zone, then you're expecting price to go up. This zone will never be what a demand structure because this is really ugly. Look at how market is moving to the upside, right? Really, it's not really nice. This will also be what a demand, sorry, a supply structure because of the move to the downside, right? A quick move to the upside, strong market retreats back to that region, market goes back up. Why does this keep logging up? Okay, so the freshness of the zone, right? Now let's look at something. It says strongest two, and then strong one, weak zero. Now, what does this mean? The first sign to the level, meaning this is really strong, right? You have a demand zone, a buying zone. Price goes up. Price is approaching that zone for the first time. This becomes your stronger zone, meaning price is more likely to go up. This is strong, strong but not strongest. Meaning this zone can also get retested and go back up. But compared to this one, this is more likely to go up than this one. This can get broken because the zone is not what fresh. Now, when you have one, two, then the zone is really not. It's weak, right? It's really weak. An example is this freshness of the zone. This is really fresh. Market hasn't approached this level yet. So if price is coming down, price is going up to this side, then I'll be expecting price to do what? To go back down when price hit this level. This is an example of the second one, right? You have a very strong move to the downside. This becomes your what? Your supply zone or your supply structure. This was probably a drop based drop or a rally based drop. Price move into that region, price goes back down. Price return back to the region for the second time, price still goes back down. Now let's look at this one, right? This is a the one that says it was weak the third times, right? So price, this was what a supply zone. Price hit this level, consolidation, price went back to the same region and price went down. Now price is coming up. The third time price breaks this level. Price wasn't able to do what? To retest this level and go back down. Freshness of the zone. An example is also this one, right? You have a zone here. Price return back to that zone and then price goes back up. This is fresh. Once you have a fresh zone, then price is more likely to what? Return back to that region and then go back up. But if the zone is not fresh, then there's a likelihood that price will break this level, right? So if the zone is more fresh, then price is more likely to go up. This is also an example, right? There was a very strong move to the upside. This was probably a drop base rally, right? You have your base, which is this side, and then price is approaching your base. Your base. I'm expecting price to go up. First pullback, second pullback, right? Fresh zone. Fresh zone is always necessary. If the zone is not fresh, the zone can break. This is an example, right? You have a base, price returned to the base, price went up. Second time, it went up. Now, if you see that price is really, there is indication of weakness in price. Look at how price is. Price wasn't able to break this side. Price wasn't able to break this side. Price wasn't able to break this side. You have your first pullback, second pullback. You just close your trade. If you think about holding this, price might you know, break your level. And I don't know, can you see this? A drop base drop. Price returned back to that region, and then price went down. A drop, right? Base brief consolidation, and then drop. And also, most of the time, this is how you get quality zones, right? This zone has to be a previous demand structure, which was flipped to a supply. If you actually understand what I'm saying, let me use trading view to explain. Let me take everything off. So let's imagine, right? Let's price is moving up and price goes back up. Now I have this structure as my what? My demand structure. I'm expecting price to hit that region. Price did this, went up, hit this, went up, right? And then price hit this level. Price showed me indication that price was going up, but price didn't go up. Price did this and then broke this level. Now, if I'm looking for a supply zone, this is a really strong move to the downside. This side is going to be what? My supply zone. Because this supply zone is strong because this was a supply zone that broke this level. So even though this side is going to act as my what? My resistance. Sometimes you see that you have resistance, but market goes up a little to the upside and then goes down because the demand or the supply zone is on this side. So price needs to go back to that demand zone and go back down, right? So this is how it looks like. This is my region. This is my zone. This was the zone that broke this level, and this is also a rally. Sorry, a drop, base, drop. Price return back to that same place, and price goes back down. All right, the breakout of the previous support and resistance level. Let's see. What is it saying? Okay, so I have price going up, right? Price retracing, price went back up. This was the zone where I was expecting price to what? Retrace. Let me do that this side. Price goes up, price does this. I'm expecting price to retrace at this level, right? So I was having this zone as what? My supply zone. But price wasn't able to what? Um price wasn't able to retest this and go back down. But actually price broke this. So this zone is still gonna be your what? Your supply zone. It's like resistance getting broken. Once your resistance get breaking or broken, sorry, your resistance becomes your what? Your support. It flips to become your what? Your support. And then once support get what? Broken, support becomes your what? Resistance. It's the same thing. Demand get turns to supply when it get broken. So this was my supply zone, right? Price broke this supply zone. Price came back to this supply zone. But this is now going to be your what? Demand zone because demand supply has been flipped to demand. So you expect price to hit this level and go back what? Up. And usually you have to also consider the movements of what? The price going up. There's a very strong move that broke the resistance, right? So you'll be expecting price to return back to that region and then price goes back up. This is also an example, right? A break of structure. Once you have a break of structure, you'll be your zone. So basically, what we are talking about here is also the how to find quality zones. How to find quality zones. The zone has to be a break of structure. Once it breaks structure. It's telling that a zone is really strong. It was so strong that a key level demand or a key level support or resistance was what was broken. So this was a level, this candlestick broke this level. So this becomes what? A supply structure. Once price get to this place, I'll be expecting price to do what? To go back down. All right, so the risk reward ratio. I think I spoke about this the last time, right? So for the risk reward ratio, this is how it has to be. For every demand zone or for every supply zone, the zone has to move three times. The move should be three times your zone. So if this is my zone, then the move is supposed to be three times as this. So if this is 10 pips, then the move is supposed to be what? 30 pips. Now you have, if you have 30 pips, then your zone becomes what? Valid. If you don't have 30 pips, then your zone is not valid. That's not a demand or a supply zone. Once you have less than three times the move, then the zone becomes really weak. So if you have less than three times the move, don't take your trade. If the zone is more than three times your move, that is when you take your trade. So if I have price going down like this, I have a demand structure. Price moves like this. You don't consider this zone as what? Your demand structure. Because this is not three times your move. But if the move was like this, then this becomes your what? Your structure. Then you expect price to retrace to this side and price goes back down or to this side. Okay. So your risk reward ratio, right, is always going to be three times your profit is always going to be three times your risk. And then if I'm risking 20 pips at this side, then my profit is going to be what? 60 pips. Always. If you go more than your risk, right? If you go more than your risk, that's up to you. Because usually what I what I've been seeing is price always move three times your risk. If you get that, if price moves three times from this region, right? As you can see, price moved three times from this region, more than three times from this region. Price retraced back to that region. Price also moved what? Three times more than this region. Once price moves three times more than this region, your take profit is gonna get hit. But if you extend this, price might hit this level and go back down. So the best thing to do is you can actually open two trade. The first one is gonna be 1 to 3, right? And the second one is gonna be whatever you want your take profit should be 1 to 10, 1 to 20, whatever you want your move to be. But the first one is always gonna be 1 to 3. If you have more than three, then price is more likely. If you have more than three, price is not more likely to hit your your level or your take profit. Price will move 1 to 3, but the next one is not really guaranteed. Now this is called the alignment with high time frame direction. Now let me show you how this works. This is what Willie J teaches, right, in his demand and supply, the alignment of time frame. So basically what he says is that let me bring this back on. So usually it's so the alignment of time frame is to it's kind of like a daily pullback strategy. So usually you start with a high time frame, right? You want to see, is the market aligned? Is the market trending? This is what you do. Is the market trending? How do you know if the market is trending? The monthly time frame, the daily time frame, and the weekly time frame has to be aligned. So if the monthly time frame is going up, the daily time frame, the weekly time frame, right, also has to be bearish. If it's bullish, then you don't consider this pair trending or you don't take this trade, right? And this is what I'm talking about with a daily pullback strategy. This is not demand and supply, right? This is demand and supply, but this is a different type of demand and supply. This is the daily pullback strategy. So this is what it says. If the daily time frame, the weekly time frame, and the monthly time frame is not aligned, you can use the daily time frame, sorry, the pullback strategy. So let me see if I can actually find one. Okay, let's see. No, this wouldn't be good. So this is all you can do, right? I'm not really sure if what I'm doing will actually work. But like, first of all, you start with a high time frame, which is the monthly time frame. Okay. With the month, this wouldn't work because on the monthly time frame, this is what? Bearish. And on the weekly time frame, this is bullish. So this wouldn't work. So you keep changing time frames. You keep using this same thing. This wouldn't work. Let's look at this. Would this work? So on the monthly time frame, this wouldn't work. I think this will work. Wait, hold on. This is bearish. Let me check on the weekly time frame. Okay, yeah. So this will actually work. This will work. So let's look at this one, right? On a monthly time frame, this is what? Bullish. On a weekly time frame, this is also what? Bullish. On the daily time frame, this is also what? Bullish. So this is what you do. You take your Fibonacci retracement to, okay, yeah. You put the first one on the body like this. And then the next one is going to be on the body of what? The opening price of the candlestick that opened for the next day. If you actually understand what I'm saying, what I mean is, let me take this off and explain this again. So you have two lines, right? This line, the first one, and then the second one. Your first line is going to be on the opening price for a bullish candlestick. This is the closing price and this is the opening price. So it's going to be on the opening price of the candlestick that you want to look for that retracement. So this is retracing. I want to find a zone where this is more likely to retrace to and go back up. So your line is going to be here, and it's going to be, the next one is going to be on the opening of the next day. This is the next day. I'm using the daily time frame, right? So this is one day, this is another day, this is another day, this is another day. But I'm trying to find a pullback, right? Where is this more likely to get to and go back up? So what I'm basically doing is, this is the opening price. This is also the opening price. This is an opening price. This is an opening price. So I put um my first line, right, on the opening price of the day before this day. And then the next line is going to be on the opening of the day you want to look for that retracement. And then once you have this, you switch this to a 2 hour time frame, right? On a 2 hour time frame, this is what I'm seeing. So this is the whole day, right? It starts from this side to this side. So this is the whole day. This candlestick was a whole day. Now, on a 2 hour time frame, you want to identify a place where market is going to retrace to and go back up, right? So this is where you look for demand and supply. If on the 2 hour time frame you can't find a demand structure, then you keep switching time frames until you find your zone, right? So you switch to the 1 hour time frame. Am I seeing a zone? I'm not seeing a zone. You switch to the 30-minute time frame until you find a zone that you are looking for, right? Now, what I'm seeing is this side, right? This is what I am seeing. I don't know what you're seeing, but for me, this is what I'm seeing as my zone. Because this was the candlestick before what the rally to the upside, and this was a very strong move to the upside. And then when you look at this side, this was actually what? A zone that was flip, a drop base drop, right? And this was flip. So what I'm expecting is, I'm expecting price to retrace to this level, and then I take my trade to the upside, right? This is why I'll be looking to take my trade to the upside. Okay, so let's look at if we can actually find a different. Let's use this one and see. So, like I said, the first thing you do is you check, is the time frame aligned? The monthly time frame, the weekly time frame, the daily time frame has to be aligned. This is the monthly time frame. The weekly time frame is bearish, so this, you don't consider this aligned. You go to a different pair. I don't think this is gonna be aligned. All right, let's look at the weekly. Okay, wait, let me see the monthly. I don't know if this is not aligned. Right, this is a doji. Okay, let's look at this one. This is not aligned. Right, so this is basically the pullback strategy that Willie J teaches. It has to be aligned. If you don't have an alignment, then that zone is not considered a pullback strategy. You can't use a pullback strategy on that one. It has to be aligned. It has to be aligned. All right, let's look at Euro USD. On the daily time frame, no, it's still not aligned. This is not aligned. So yeah, the only pair that I think it works for today, right? Because maybe tomorrow is gonna work for a different pair. So today, the only pair that it works on is the Euro USD. That's the only pair that it works on. Let's look at this one, the Euro NZD. It's still not gonna work on this one. Oh yo, it's not gonna work on this one. So the only pair that we can see for today is the Euro USD. Maybe the next time that I do a Zoom call, we'll find a different pair. So this is what we talk about when we talk about the monthly time frame or the higher time frame alignments, right? The monthly time frame, the weekly time frame, and then the daily time frame has to be aligned. So if the monthly time frame is bullish, then the weekly has to be bullish, the daily has to be bullish, and then the weekly has to be bullish, the daily has to be bullish, and then the monthly has to be bullish. And I'll send you a video that basically explains this. It explains everything. I'll send you a video right after this. All right, let's look at this one. Okay. So the monthly time frame, what we are seeing on the monthly time frame is we are seeing a very strong move to the downside. This is a very brief consolidation, and then you have a strong move to the downside, right? So what this is doing is this is a monthly downtrend, right? And then this is also a monthly supply zone. This is also a monthly supply zone. And I don't know if you can actually see this clearly, but look, I have a level here, right? Where I was literally expecting price to hit this level and go back up. But price broke this level. And then if you can actually see what is happening here, we have a candlestick here, right? And this candlestick, if you take this is a monthly candlestick. So if you take this to a lower time frame, you actually find out that this is what a drop base and then drop. Once you have this drop base drop, then this becomes what supply zone. You expect price to rally up to this side and goes back down. And then price goes up to that level, right? I don't know. I'm not really sure if this level is this or this, but I think this is probably, I don't know which one this is. But yeah, this was a very strong move to the downside, right? This was consolidation, consolidation. And then this was a very strong move to the downside. Once you have this strong move to the downside, then the next thing to do is you look for a place where the orders were being placed. This is where the orders were being placed, right? Price move in favor of the sellers because there was a lot of what sell orders around this region. Once you know that region, then you expect price to get back to that place, and then price goes back down. Same thing applies for this one, right? So this he had multiple time frames, right? This was the first time frame. This is actually on the weekly. First supply zone, second supply zone, and then third supply zone, right? This didn't get mitigated. This actually got mitigated. Price pulled back to this region, and price went down. This was his second entry, right? Price retraced and price went down. For this one, this is a drop base drop, right? Also, we have a very strong move to the downside. So he considered this. So it's usually about the movement, right? The movements of the price. If there's a very strong movement of price to the downside, then you look for a place where consolidation was you look for a place where the orders were being placed, and then you draw your supply or your demand zone depending on where price went. So if price went up, then this is zone is going to be your demand. But since price went down, then this is going to be what your supply zone. Same thing with this, right? Price moved down. This is a very strong move to the upside. You look for this, the place where the consolidation will be taking place, and then you what? You can also have a buy limit around this region. So like I told you, your Prisma line is going to be here. Your distal line is going to be here. Your Prisma line is going to be your buy order, right? The price. And then your distal line is gonna be your stop loss. This is also a very strong move to the downside, right? If you can actually see this wasn't a strong move to the downside. This wasn't a strong move to the downside, but this was a strong move to the downside. So he considered this as his what supply zone. Price went back to the supply zone and price went down. This is his demand zone, right? This was a level that he was expecting this level to get um retested and go back down. My price actually broke this, retested this. So he found this place to be what is demand zone. And this actually moved three times what the level. Price returned back to that zone and the price went back up. Right? This was the zone. So he actually took this to a very lower time frame. This was the level, right? This one. This was the level. So you can actually have multiple demand zones. Because what actually, if you actually use the risk management that I told you, right, this is gonna move three times. This is gonna move three times. This is gonna move three times. But let's say you had your first zone, and then your take profit is all the way here. Market will move three times, and then retrace, move three times, retrace, move three times. So even though your take profit is here, this is go up and hit your stop loss, go up and hit your stop loss, go up and hit your stop loss. So you have to follow the risk reward plan that they have. One, two, three, right? Once you master the strategy, then you can extend your stake profit. Because once you master this, you will be able to identify zones where you know this zone is gonna move more than three times. Right? It's all about practicing. It's all about practicing. When I really started doing this, right, I usually have zones, this get broken and then it goes back into my direction. I'm like, why did this happen? Right. And let me see if I can actually show you a very nice example. So this side was the demand zone, right? And on the 4 hour time frame, I'll show you. This is what I did. I had my zone at this place. This is where I had my zone. But I was like, wait, hold on. Market what went down to this side. Is a what? A drop, base, and then drop. But what if this zone get broken? So what I actually did was I had my zone at this level, right? And also I had my zone at this level. But then I changed my stop loss from this side to this side. So my stop loss became something like this. Because I knew this was a weekly, this was a daily supply zone. Once you have that daily supply zone, which is this, right, then price is more likely to move really huge to the downside.